So is Social Security completely tax-free now? You've probably seen the headlines and they sound incredible. Social Security, tax-free. And you may have heard politicians talking about the one big beautiful bill and the amazing promise that after working your whole life and paying taxes, they're finally going to leave your Social Security alone. It sounds like a dream come true. But is that what's really going on? Can you actually plan on paying zero federal tax on your Social Security this year? Well, of course, like so many things, the real answer is a lot more complicated than a simple headline. While there has been a massive tax change for seniors, it's not the blanket tax repeal that they are hoping for. The truth is, for some retirees, you're going to save a lot of money, and this is a game changer. But for others, it's not going to change anything. And then those in the middle, maybe those are going to be the biggest winner. But let's go ahead and separate fact from fiction. Stick with me, and I'm going to break down what really happened, who actually gets the tax cut, and what the law truly is versus what you may be hearing all over YouTube. Okay, so let's tackle these headlines head on. For months, we've been hearing out of Washington that they're going to get rid of tax on Social Security. You've been hearing it on all the news channels. And with the passing of the one big beautiful bill, the message was simple and powerful. You paid into the system your whole life. You shouldn't have to pay tax on it again in retirement. And a lot of people really like that, and we're hearing that all over the place. But I need to be crystal clear. Just because this bill was passed and signed into law does not mean that they've eliminated tax on Social Security. The old formula for taxing Social Security still exists, it's still on the books, and Social Security is still taxable. But what they did do is they added a new deduction for seniors to be able to reduce the tax. And that was a way for them to work around. They had to manage everything in reconciliation. I talked about that in other videos. But they had to work within a budget, and so they couldn't truly get rid of it. But what they did give us is a gift for a lot of people, and that's going to be a deduction. And by giving you a large enough deduction, it pushes that income down enough that a lot of people actually won't have to pay tax anymore, and that's a lot of what you've been hearing out there. And so while it is true that 88 to 90% of people are no longer going to be taxed on Social Security, you have to realize a huge percentage of those already weren't taxed on Social Security, because if Social Security was your only source of income, it wasn't taxable. And then you had to have enough other income in order for it to be taxable. And there's a whole formula on how to do that. And maybe we'll cover how that works in a different video. That'd probably be a good backup to this. But I just want you to understand the big takeaway here is Social Security is still taxable, so we need to work through the process. Okay, so in order to pull this off, they had to make some compromises, and that's what most legislation is give a little, take a little, and they couldn't completely make Social Security tax-free. That would have just blown a hole in the budget. It would have caused all kinds of problems with Social Security, because when Social Security gets taxed, it goes back in, it helps fund future payments. So there's a lot to this beyond just what's on the surface. But what they did do is they created a deduction that's going to help those in the middle. Those who have lower income were getting taxed anyway. Those with higher income, they set income thresholds so that they didn't get the benefit, and there's a sweet spot there. And we're going to talk about that here in a minute and show you exactly how it works. So stay with me. We're going to get into the nuts and bolts of this, but I want to kind of give you a little bit of background first. But we're almost there, so don't take off yet. Okay, so what did happen? Effectively January 1st of 2025, so retroactive for the whole year, this bill is now in force. And what did it actually do? Well, what the one big beautiful bill, kind of crazy to even say it, but what it actually did is it gave individuals over 65 a $6,000 deduction, and for married couples a $12,000 deduction. Now, what this deduction does is it's going to effectively lower your adjusted gross income, which means it's going to lower your combined income, which means it's going to lower how much you're going to pay taxes on. And that's a big win. So for a lot of our middle income taxpayers, our middle income seniors, this is really going to lower our taxes quite a bit. And maybe for some of you, even go ahead and eliminate Social Security taxability altogether. So that's going to be a big win. But how does it actually work? So let's take a look at that. Now, this is from section 70103 from this behemoth of a bill. I promise you don't want to read it, but it's termination of deduction for personal exemptions other than temporary senior deduction. So if you really want to look it up, it's 70103, and you can check me up on all this stuff. But essentially what has happened is they've set income limits. So if you're single, that income limit is $75,000. And if you get to $150,000, you're completely phased out of this deduction. For married filing joint, that number is $150,000, completely phased out at $250,000. And how that works is they've said for every dollar you make above that minimum, so $75,000, you have to take 6% of the deduction away. Well, that sounds really complicated, but I'm going to show you what that looks like. It's not that hard. To keep this simple, remember we said $75,000 is where this starts with the phase out. So if you made $85,000, you take $85,000 minus the $75,000, that gives you $10,000. You multiply that times 6%, easy math, that's $600. You get a $5,400 deduction on your tax return. And really, it's that simple. So if you made $100,000, once again, this is for single, $100,000 minus $75,000 is $25,000. $25,000 times 6% is $1,500. So we would subtract that from that $6,000 deduction you got, and you're going to get a $4,500 deduction. Pretty simple, right? If you follow that math all the way through, when you get to 150, there's no deduction left. Now, what about married filing joint? Married filing joint, same thing. We'll do 10,000. So remember, your cutoff was 150. So let's do 160,000 minus 150,000 is 10,000. But don't multiply it times 6. This is a mistake I've seen quite a few people make. What you're actually going to do is multiply it times 12%. Why 12, you say, Doug? Well, because there's two of you. 6% for spouse 1, 6% for spouse 2. So what happens there, 10,000 times 12% is $1,200. Instead of a $12,000 deduction, you're going to get $10,800. Couple more examples here. 175,000. Let's say you made 175. Remember, we have the 150 is where it begins to phase out. So 175 minus 150 is 25,000 times 12%, which I just explained how that works, is 3,000. You're going to get a deduction of 9,000. I think this is important to understand because people are going to say 150. Oh, I got to panic. I can't make any more money at all. Well, no, that's not the case. It's going to be a phase out. Couple more here. 200. So if you made 200,000 minus the 150 is 50 times 12% is $6,000. You're going to have a $6,000 deduction that you can still take. So it's not the end of the world. And of course, at 250, you follow the math out there. There's no deduction left. But what that does mean is there's a huge opportunity for tax planning this year to really manage where your money comes from. And so often people don't think about that. And we love to help people with those kind of things. But if we know we have this $150,000 beginning of a phase out, or $75,000 if we're single, and we have multiple buckets of money, hopefully we've got our qualified money in our 401ks or IRAs, we got our money in our brokerage accounts, maybe some money in some cash value life insurance, maybe some money in savings accounts. If we have multiple sources of income or places that we can pull money from, we can start to choose wisely where we're pulling it from so we can make sure we take advantage of this deduction. Not saying we make everything for tax reasons, but it's something to keep in mind, and I want you guys to start thinking about that stuff. We have plenty of time left to plan for this, and maybe instead of taking that extra distribution from your IRA account, maybe this year we're going to take it from the brokerage account so we preserve this $12,000 deduction. Something I want to think about because, look, this thing expires in just a couple years. 2028 is the last year, so we get 25, 26, 27, and 28. 29, this deduction is gone unless it gets extended. So we've only got 4 years to use this deduction, and we don't want to let it go to waste. So I want us to be thinking about this and make sure we don't miss out on it. Now, a couple things to think about too. You have to be 65. So a lot of times we're married to somebody who's older or younger than us. Maybe you're 66 and your spouse is 64. Well, in that case, you're only going to get one $6,000 deduction. Something else that hasn't been mentioned in the bill when I went through it yet is head of household. So I don't see any mention of it. So at this point, if you're head of household, you're going to be treated like single, and I don't think that's going to change. I think that's the way it's going to stay. They didn't mention it. You're going to be one person. I don't see any room for that to change because this is already kind of a budget buster for them anyway. So I think that's where we're going to be. So hopefully you're finding this useful, and it's helpful to have somebody actually show you how it really works. And if so, go ahead and please ring the bell, subscribe. We're going to be bringing a lot more information out on this kind of stuff. And let's be honest, a lot of this stuff is going to go to Treasury, and they're going to have interpretations too on a lot of these things. So I want you to know about that. But what that really means, and I have that here, is for a married filing joint now, our standard deduction got bumped to $31,500. And then you're going to get a $3,200 deduction for being a senior. And then you're also going to get this $12,000 deduction as long as your income limits work. So that means we're starting off with basically a standard deduction of $46,700 for single, $6,000, and then you're going to have $15,750 is going to be your new standard deduction, and then the $2,000 for being a senior. So you're starting with a standard deduction of $23,750. So once again, tax planning opportunities here depending on what you're doing. And we also may want to be thinking about this for those of you doing Roth conversions. Now we got to take it into account when we're doing a Roth conversion if we bump it up against these, because now we're going to run into some extra tax consequences of the Roth that we may not even thought about because of this $12,000 deduction. And on top of that, this $12,000 is separate from the standard deduction, itemized deduction, because of where it is in the on the tax return. So what that means is you'll be able to use the $12,000 and itemize or not itemize. It's a separate line item, or at least it should be. I think that's how that's going to work out. So you could have a standard deduction, or you may have an itemized deduction of a whole lot more, especially with the SALT tax, and still get to use the $12,000 even though you itemize. So that's a big distinction too that you may not have thought about. So there you have it. Is Social Security gonna be tax-free? Depends on your situation, right? The truth is Social Security is still taxable. However, it's taxable based on the tax rules that we've basically had for a long time. We've just got an extra deduction, which is gonna help some of you not have to pay tax. For some of you, nothing's gonna change. But that in that middle section, there's a big advantage here, but also some catches that we need to be careful about. Like I said, where are we taking our income from? Are we doing Roth conversion? So I don't want us to lose sight of the important things and just focus on this, but it really is going to be a good deduction for a lot of us, and we want to make sure you take advantage of it. But I indicated this earlier, the tax code is always shifting, and the IRS is going to be releasing more guidance. As that comes out, we will let you know. So make sure you ring the bell, you subscribe. I'm going to keep you up to date, and I'm going to always shoot you honest answers. And with that, we'll see you next time.